Hey, thanks for joining us. We're here talking with Akhil Suresh, who's a business development manager at the London Stock Exchange, specifically focusing on the fund segment of the LSE. And over the last year and a half, as we've been getting to know the LSE team, I've been really impressed in terms of what London is actually doing in terms of listed funds and their venture capital trust program. We've talked to, I believe, 17 stock exchanges worldwide, and the London Stock Exchange is really the only market in the world that actually has this. So I'm really excited to have Akhil join us on the conversation and to let us know a little bit more about this program, what they do, and kind of some of the unique characteristics. Akhil, welcome aboard. Thanks, man.
Great. No, thanks, Jonathan, for the opportunity to speak.
Can you tell me a little bit about kind of what your role is in terms of the London Stock Exchange universe and kind of what's your slice of it? What's your piece of it?
So as you mentioned, my role as a business development manager really, focuses on closed-end investment funds. I work with investment banks, legal advisors, fund managers, and kind of guide them through the listing process for listing a closed-end fund in London. And also engage with them after an IPO and after they come to market to provide, support, either, amplifying their message as a listed fund on the exchange, as well as engaging with the buy side who also invest in our fund market and, making sure that we as a market understand their requirements.
No, that's fantastic. Can you tell me a little bit about the fund market in London? Because I understand that you guys are probably one of the world leaders in terms of closed-end funds. Can you actually tell me, what does the fund market look like and how is it different than, for instance, say the US fund market?
So the London fund market is quite mature. So it's over 150 years old. The first fund that was listed, FNC Investment Trust, is still listed today. It's still paying a dividend every year for 150 years later. So it's quite extraordinary that the kind of history behind the market. Now, it's a market where it's quite diverse in nature. So it's across geographies and asset classes. So you have equity funds, and we'll touch upon this probably later, but we also kind of ventured into alternatives in the listed fund space. So it's quite diverse in terms of what it can offer. In terms of the size, it's quite sizable in nature as well. So over $280 billion is the collective valuation of listed funds in London. In terms of the differences between the US, so I think in the US, the types of strategies that you see are mainly equity and fixed income and municipal bond focused funds. Whereas in the UK and in London, you see alternative investment fund, more esoteric asset classes. So we've seen royalties, infrastructure, more so in the renewables and the social infrastructure space as well. So that asset class shift is present in London within a closed-end fund vehicle. Aside from that, I would say in terms of launching a fund itself, it's more cost effective for a fund manager to launch. So about 2% of the capital raised as part of a launch is essentially the fee that comes out in the UK, whereas in the US, that's quite much higher. And then also the fund manager is expected to pay that fee. Whereas in the UK, you can take that fee out of the capital raise on admission.
No, that's fantastic. And who are the key participants in this? And what are some of the trends that we're actually seeing? I know that the B word, Brexit, has been kind of a huge issue in the UK capital markets over the last couple of years. How are people responding now that Brexit is kind of done and settled? I
think Brexit for the past 4 years has kind of had a cloud over the IPO market in general in London, but in the fund space in particular. We've seen record years in capital raising actually after the referendum vote in 2017. In 2018 and 2019, there was strong further issuance. So existing funds coming back to market to raise further capital. And even last year, despite coronavirus also getting in the mix with Brexit, it was a strong year for capital raising. So I think overall, despite macroeconomic events such as Brexit and the pandemic that hit, the fund market has stayed resilient. We've had just 2 IPOs within last month, with about a couple of more due to launch next month. And over the past couple of years, the IPO market, although it has stalled, the further issuance market has kind of balanced that in terms of the capital raises.
No, that's fantastic. Can we talk a little bit about the comparison between the US and the UK fund markets? I know that in the United States, part of the Securities Acts, or part of the suite of laws that actually govern securities in the United States, you have the 40 Act in the United States, which really creates a separate category for fund entities, a whole different list of reporting requirements. There's increased compliance costs and that sort of stuff. And so when we've actually been researching taking a venture capital fund to IPO in the United States, we were looking at like $3 to $5 million in costs and about $2 to $3 million in compliance. Can you do a little bit of a comparison and contrast for me in terms of like the cost of launch of this type of fund in the UK? And then we can kind of go into some of the strategies and regulatory oversight and that sort of stuff down the road.
Yeah, sure. In terms of costs, the 2% of the capital raise as flagged is really the cost of launch. So that includes paying your investment bank who's helping with the IPO and sourcing the capital, legal advisors, as well as other market participants, such as fund accountants, fund administrators. So there's a collective kind of ecosystem which helps you launch a vehicle in London, which is well experienced. It's a well-trodden path to launch a vehicle. So it's a much more streamlined process, and it's a much more well-understood process, and it's more welcoming to newer fund managers who haven't launched funds before in London. I think one of the things in the US market, you have a lot of large sponsors continuing to launch funds, and there's perhaps not a newer manager who has never launched a closed-end fund before launching a vehicle, whereas London is more welcoming in that sense.
One of the things that completely blew my mind when I was first getting acquainted with the London Stock Exchange team is that you guys have a publicly traded venture capital program, and this is actually quite common in the UK. And when I actually tell my fellow fund managers this, they're like, wait, what? You can actually list a venture capital fund publicly? Talk about that a little bit. Talk about why would a venture capital fund actually choose to IPO or choose to be a public fund as opposed to a private fund? Like, what are some of the advantages that you would have, and what are some of the challenges that you would have as a publicly traded venture capital fund?
Yeah, sure. So I guess one of the kind of key sticking points on a private, VC fund structure is the time or the length of the fund which exists, right? So if you're set up as a 5-year, 7-year type vehicle, the length of the investment horizon is quite short. So you might have commitments that you would need to kind of dispose of because of the fact that you're meeting certain return requirements. So you might have to sell certain investments just to hit your return targets. Whereas in a closed-ended listed vehicle, it's set up as a perpetual vehicle in nature. So it's set up with an unlimited life, and every 7 years, for example, you can have a continuation vote where existing shareholders can choose, depending on how the performance is, how the portfolio is doing, to continue with the fund or decide to wind up. But in essence, the fund kind of continues in perpetuity. So that's one reason. I think the second reason is you're accessing, as a VC fund, a completely new investor base. So both from a retail point of view and an institutional investor point of view, who, both of those pools may have had difficulty investing in your private VC fund, whereas in a listed fund structure, that might open up their mandate to invest in a listed VC fund and also kind of get exposure to everything that you're offering. So those are, I think, a couple of aspects to consider. The final thing I think I'd mention is the ability to raise further capital. This is a real hallmark of the London listed fund market, compared to the US as well, where it's not as common for funds to come back after they've IPO'd and raise capital. In London, it's quite common to do that, within the first 12, 18 months after IPO. So you can continue to grow. And as you identify new opportunities, you can, kind of follow an acquisition-led strategy or kind of double down on existing investments within the structure. So those are some of the reasons why we've seen VC funds come to our market.
So in the traditional kind of Silicon Valley, kind of the legacy venture capital model, a VC would essentially, they'd go out, they'd raise fund, they'd find limited partners, they would actually invest into the partnership, and then they would deploy that capital over 4 years, and then they'd let that mature over 10 years. And then if the VC wants to raise further capital, they would generally go and raise another follow-on fund after that. But what's interesting to me is that it sounds like in the UK, if I'm a publicly traded fund, I don't have LPs, I have shareholders.
Yeah.
Then I can actually issue more stock into that fund and I can raise more money into the same vehicle. Is that accurate?
No, that's completely accurate, Jonathan. And even you can even launch a separate share class at the same time as you're having an existing fund. And you can kind of siphon that portfolio and kind of ring fence it outside of the ordinary shares that you have. And then at a time when that separate share class is fully invested, you can convert them back into ordinaries as well. So that's also an option, if you don't want your existing shareholders to be diluted in your original fund. So there's multiple ways of raising further capital in London.
And so how long would it take to raise additional capital into a publicly traded fund? Because I mean, typically it's, to raise a traditional VC fund, it's 18 to 24 months. And so usually when the founders of the fund are, when the VCs are 2 years in, they're like, well, I got to start another fund in 2 years. I'm going to start the fundraise process all over again. Is it a 2-year process to actually raise follow-on funds after you're listed?
No. So in the London listed structure, there's a myriad of ways where you can raise further capital over the long and short term. So at IPO, you can set up a placing program. So you can then kind of meet demand as it arrives, essentially, and issue shares. You can also have a separate share class, as I think I referenced before, and offering periods for these can vary. So you can market it for 1 to 2 weeks in order to raise that further capital. In some cases you can start the placing in the morning, right, and kind of complete it in the evening or whenever the market closes. But you would have had to ascertain the demand beforehand. But that's definitely an option. So there's various ways of doing this, and from a documentation point of view, you can raise up to 20% of your issued share capital without issuing another prospectus. So it's a very efficient manner in which you can raise further capital in London.
Yeah, raising further capital within days or weeks is much different than a couple of years. That's fantastic. Can you give me some examples of VC funds that have listed in the UK and why they've been successful?
Yeah, sure. So I think one of the highlight and success stories has been Draper Esprit. So Draper Esprit listed on AIM in 2016, raised about $100 million, and since then it's gone on to raise further capital 3 times and raise about $400 million. Again, it's focused on high growth technology businesses in UK and Europe. And I think what sells the story there is really the founder and the strong track record of the management team and what they're giving access to. And I think this is really important because these investors in the VC funds, and Draper Esprit is an example, is that they can't access those portfolio companies by themselves, these institutions and retail investors. So that's why through Draper Esprit, as an example, they can get exposure either in the secondary market or through further issuance, as we've mentioned before, where they can kind of invest in that sense. So now Draper Esprit is standing at over $1 billion in market value. So it's quite sizable in nature. Another fund, which I think is worth mentioning, is Augmentum Fintech. So that was the first publicly listed fintech fund in the UK. And it raised 130 million at IPO It's come back to market to raise 69 million over two further issuances. And it's, again, a similar story in terms of the founder and the exposure that they can provide across a range of UK and European fintechs, which cannot really be accessed by the everyday investor or even institutional investors seeking to get exposure to the growth stories that are occurring.
Fantastic, Akhil. Can you talk a little bit about kind of paths to listing for a fund and kind of routes and how funds normally do this?
Yeah, sure. So in London, there's three main routes to market. So the first and most prominent route is the premium segment of the main market. It allows both retail and institutional investors to invest in funds listed on that market. There's certain requirements such as free float being 25%. There needs to be a spread of investment risk. But I think the benefit of that route is index eligibility. So you can get access through passive demand to the FTSE UK Index Series, which quite a significant portion of our listed funds are. Then there's the specialist fund segment, where it's a bit more flexible in terms of requirements. So there's no prescriptive free float. There's not a requirement necessarily per se for a spread of investment risk or risk diversification within a fund. And then there's also the aspect to consider is it's a professional only market. So retail investors are not necessarily the ideal investor audience for that market. And then there's AIM, which can appeal to both retail and institutional investors. Similar to the SFS, there's no prescriptive free float. And it's actually a route which quite a few venture capital funds have taken to list.
Oh, fantastic. And can we talk about kind of emerging markets? Do you think that there's actually a market or demand in the UK for kind of access to emerging market assets?
Yeah, so that's an interesting question, Jonathan. So in terms of emerging markets, what we've seen is typically these funds that are listed are focused globally. So they're not necessarily focused on a region, although there are a few focused on LATAM and emerging Europe, but the majority of them provide global exposure. And this is the underlyings, I should say, for these funds are mainly equity focused, listed equities in these emerging markets, some debt instruments as well. So that's how the market is kind of currently constituted. But I think in terms of the kind of the future of the market, there's certainly, you could see that as the emerging markets kind of sector grows in London and more so broadly in terms of the types of assets that can be accessed, it is definitely one to watch to see whether there could be further activity in that space.
That's fantastic. And then what is the market actually looking for in terms of new launches? Where is the market appetite that you guys actually see?
I think that it's shifted to alternatives in the sense that it's non-equity, non-fixed income focused underlyings. So I think, as mentioned earlier, the likes of infrastructure, renewables, royalties, has been kind of dominating from a capital raising perspective in new issuance. In terms of what the market I think is looking for, I think you have to ask one question as a fund manager or as a collective looking to launch a vehicle is, how would this be different from the existing funds on London Stock Exchange? Because again, it's a mature market. There are a diverse range of funds available. So a conundrum an investor might face or a consideration would be, should I go into this at IPO, or is there an existing fund on the market that's already trading at a discount, which could be a better proposition, right? So whatever you're bringing to market, I think it would have to be differentiated to what's already in London. I think that's one of the main considerations. The other aspect is having a track record, right? So you don't have to have a track record necessarily with respect to a listed, closed-end vehicle, publicly listed in London per se, but in terms of the expertise and your asset class itself, that's definitely something that the market is looking for. the last aspect I'd mention is in terms of the scale at which you come to market. You know, London is different from the US in the sense that there's perhaps a lower barrier for entry for listed closed-end investment vehicles, which are raising in the US probably $200, $300, $400 million at launch. You know, in London, you can get vehicles that raise about $100 million, for example, at launch, and then you can scale up. So that aspect, I think, is definitely worth considering. You can certainly launch at a lower end of the market, but being able to say how you will end up growing and what the story will look like down the line once you've fully invested is a proposition that I think that needs to be well communicated to the advisory community and investors.
Fantastic. Akhil, this has been great. As always, I always learn a ton when I'm talking to you, sir. So thank you very much for your time. I really appreciate it. And looking forward to continue working with you.
Great. No, thanks, Jonathan, for having me. And we look forward to educating your audience on the fund market. Thank you.
Excellent. Cheers.
Thanks.